Welcome back to the deep dive. Our mission, as always, is to cut through the noise, process the data, and give you the clearest insights. And today, we're tackling Costco. Huge retailer, right? Everyone knows them. They just finished their fiscal year 2025 back at the end of August, and the numbers looked, well, fantastic on the surface. Record sales, strong profits, but then the stock kind of stumbled, dropped about 3% on September 25th. Not a crash, but, noticeable. And that's the puzzle we want to solve today. Why the, let's say, lukewarm reaction from Wall Street to what looks like a great report? We need to get past those headlines. We've got to dig into how Costco actually works, because it's pretty unique. Is this just a small blip, or is there something more going on? Maybe slower growth, meeting a really high valuation. Let's find out.
Yeah, to really get why investors might be cautious, you first have to appreciate Costco's scale and its peculiar business model. They did $270 billion in net sales for fiscal 2025. I mean, that's just massive. But here's the key thing. Their whole philosophy is being the absolute low-cost leader. That's job number one.
Right, lowest prices possible.
Exactly. And because of that commitment, they're not trying to squeeze big profits out of the stuff they sell. The margins on the actual merchandise, they are incredibly thin.
Wait, hold on. Even with $270 billion moving through, our sources say the merchandise gross margin is like 11%. That sounds like a lot of money when the volume's that high. Why is that considered razor thin?
It sounds big in isolation, yeah, but think about the costs. Running those giant warehouses, paying staff relatively well, the whole logistics operation, it takes a huge amount of money just to keep the doors open.
Ah, okay. The operating expenses.
Precisely. That 11% is before all that, before the electricity, the forklifts, the checkout staff. So once you pay for everything it takes to sell the goods, the actual profit left over from, selling Kirkland signature products, it's really quite small.
So it covers the costs, maybe a tiny bit more, but it's not driving the company's bottom line.
Not at all. And that leads you straight to the big aha moment with Costco. The profit isn't really tied to how much stuff people buy in the store. Because those merchandise margins are so tight, almost all the company's actual operating profit comes straight from those annual membership fees people pay.
So the $60 or $120 card, that's the real moneymaker.
That's the fuel, exactly. That fee revenue is incredibly high margin, almost pure profit, and it's paid by millions of loyal customers.
And that lets them keep prices low on the goods, which brings in more members. It's a cycle.
It's their competitive moat. A normal retailer needs you to buy more, especially high-margin stuff. Costco just needs you to renew your membership. Simple as that.
Okay, that makes sense. It's a critical difference. But if profit really hinges on memberships, why the intense focus from investors on the Q4 comparable sales numbers? Those seem to be the sticking point.
That's a great question. Because while the membership fee is the profit driver, those comparable sales figures, same-store sales, they're seen as the best pulse check on the health of that membership base.
Like, are members still engaged? Are they still shopping?
Exactly. It's the indicator for loyalty and spending habits. So let's look at Q4. Comp sales were up 5.7%.
Which sounds okay, I guess, but expectations were higher.
Yeah, 5.7% is decent growth. But the market seemed to be expecting something maybe closer to 6.5%, perhaps even 7%, especially given some broader retail trends. So a bit of a miss there.
Okay, that's metric one. What was the other key number?
The membership numbers themselves. And those looked really good. They hit 81 million paid members worldwide. That's up 6.3% from the year before. Very solid growth.
So memberships grew faster than sales, 6.3% versus 5.7%.
And that's the math that caused some concern. When analysts see membership count growing faster than the sales per store.
They figure the sales growth is just coming from the new members walking in the door.
Pretty much, yeah. The implication is that most, maybe even all, of that 5.7% comp sales lift wasn't from existing members spending more money. It was just the effect of adding that 6.3% chunk of new cardholders.
Which could mean existing members aren't opening their wallets as much, maybe pulling back a bit.
That's the worry. Either they're spending less per trip, maybe putting off buying that new TV or sofa, or, and this is the other possibility, maybe cancellations among established members ticked up a bit more than usual.
Which is a problem because the model counts on those long-term members sticking around and maybe spending a little more each year.
Definitely. Consistent profit growth kind of assumes that existing base remains stable and ideally increases their spend over time.
But didn't they say the overall renewal rate was still really high, like 90%? That's fantastic for any subscription model.
It is fantastic, objectively. 90% is world-class. But there was a crucial bit of nuance in what management said.
The detail.
Always in the details. While 90% is high, it was actually a slight dip from previous levels, and management pointed a finger directly at the source of that softness:
Okay, where?
newer members. Specifically, people who signed up online rather than in a warehouse. They aren't renewing their memberships at the same strong rate as the older, more tenured members, the ones who've been members for years.
Okay. So the long-term loyal base is solid, but the newcomers, especially the online signups, are a bit less sticky.
That seems to be the issue. And think about what that means. Your established members are the bedrock. They pay that fee reliably, year after year. That's your guaranteed high-margin income.
Right.
If the new people you're bringing in are more likely to churn out after just a year or two, it makes growing that reliable profit stream harder. It increases your cost to acquire sticky members, and it introduces a bit more volatility.
So that specific detail, the weakness in the newest online cohort, that's what spooks investors because it touches the core profit engine.
Precisely. It raises questions about the long-term sustainability of that super stable membership growth they've relied on.
Okay, so that connects the sales figures to the membership model. But now let's pivot to the other big elephant in the room, the stock's valuation. Because even with great operations, this seems to be a huge factor.
It really is.
Costco stock trades at over 50 times its earnings. The PE ratio is above 50. Now, for listeners maybe less familiar, put that in context. How does that compare to other big retailers or just the market generally? What does 50 times earnings mean?
It means the market is valuing Costco like it's a high-flying tech company, not a warehouse club selling groceries and tires.
Mm-hmm.
I mean, you look at competitors, maybe a Walmart or a Target, they might trade around 20, maybe 25 times earnings.
So double, roughly double.
Yeah, easily. The market is essentially saying it expects Costco to grow its profits twice as fast as those other guys and to keep doing it for a long, long time. That expectation is baked right into that 50x PE ratio, which is, by the way, near the highest it's ever been for Costco.
Which creates a massive hurdle for anyone buying the stock today, right? Because you can't really argue it's cheap or undervalued.
Not really, no.
Yeah.
If you're investing now, you basically have to assume that this super high valuation, this 50x PE, is going to stay right where it is or maybe even go higher.
And that's the tightrope. Explain the math there. If the valuation multiple doesn't go up, what does that mean for the stock price?
It's simple but crucial. If that PE ratio stays flat over, say, the next 5 years, then the only way the stock price can go up is if the company's actual earnings per share, the EPS, goes up. The stock price increase will exactly match the EPS growth rate. No multiple expansion helping you out.
Okay, so if EPS grows 8%, the stock goes up 8%. If it grows 10%, the stock goes up 10%.
Exactly, and that puts enormous pressure on the growth rate. Because think about the overall market. The S&P 500 historically gives you maybe around 10% a year on average.
Right.
So for Costco stock, just to match the average market return, assuming its valuation stays flat, it needs to grow its earnings per share by at least 10% year in, year out.
Just to keep pace.
Just to tread water relative to the market, and that's a tall order.
Now, they did hit 10% EPS growth for the full fiscal year 2025, didn't they?
They did. But again, you need to look under the hood. A significant chunk of that 10% growth came because they raised the price of the membership fee during that year.
The fee hike, which they don't do very often, like every 5 or 6 years.
Exactly. It's not something they can pull every year to goose the numbers. It's an infrequent lever.
So if you mentally back out that infrequent fee hike and you look at the slightly slower comparable sales growth we talked about and the little bit of weakness in renewal rates among new members,
Right.
suddenly getting that consistent 10% plus EPS growth every single year looks, well, a lot harder.
It becomes a much bigger challenge. Unless they fundamentally change their strategy and start raising fees more often, which would kind of undermine their whole low price value proposition. The main profit driver, membership growth and engagement, seems to be settling into a more modest pace right now.
Okay, let's try and wrap this up for the listener. What's the big picture here? Costco is, by all accounts, a fantastic company. Record results, incredibly loyal customers. Hard to argue with the business itself.
Absolutely. Operationally, it's a powerhouse.
But the investment case, the calculus for the stock, seems almost disconnected from that, purely because the valuation is so high.
That's the crux of it. The expectations are just immense.
So, best case scenario. Growth continues at this kind of modest pace, maybe high single digits, and the market keeps awarding it that huge 50x PE multiple. In that case, the stock might just struggle to keep up with the overall market average, needs that 10% growth just to break even, essentially.
Right. Good company, potentially mediocre stock return if the valuation holds.
And the worst case scenario.
The worst case is that growth stays modest or maybe even slows a bit more, and the market decides, you know what? A retailer, even a great one like Costco, probably shouldn't trade at 50 times earnings.
The multiple comes down.
Exactly. If that PE ratio starts to shrink back towards, say, 30 or 35 times earnings, which would still be high but less extreme, then the stock price could fall significantly, even if the company itself keeps performing pretty well operationally.
It's a classic trap. Great business, but priced for perfection, maybe even beyond perfection.
It makes the margin for error very, very slim for investors.
Okay, so let's leave everyone with a final thought to chew on, building on that point about the newer online members being less loyal. We know loyalty is absolutely everything to this business model. It's the profit engine.
It really is.
So if those renewal rates for new cohorts do keep lagging, what could Costco do? What kind of innovative things, maybe not related to just lowering prices further or fee hikes, could they introduce? Could they use tiered benefits or special digital perks, something specifically targeted to make those newer, maybe more digitally native members stickier and protect that core profit stream from these sky-high market expectations?
That's a really interesting question. How do you build that long-term loyalty in new ways?
Something for you to think about. We'll be back with another deep dive soon.